What if you could actually take the market's pulse? Measure its emotions? Well, there's a fascinating tool in finance that does pretty much exactly that. It's called the VIX index, but most people know it by its nickname, the Fearometer. And today, we're going to break down what it is, how it works, and why it's such a powerful signal for all of us, not just big-time traders.
So, first things first, can a market actually feel anything? Well, not literally, of course, but you have to remember, markets are just millions of us humans making decisions. And because of that, they're really driven by two super powerful emotions, confidence and fear. And it turns out there is a way to measure that collective feeling.
And this is where the VIX comes into play. The easiest way to think about it is like a real-time barometer for the market's mood. Its whole job is to give us a quick snapshot of that mood, whether it's kind of calm and confident or looking stormy and full of fear. Now, its official name is the CBOE Volatility Index, but let's be honest, everyone calls it the Fear Index for a very good reason. Its job is to measure the market's expectation of volatility, or how bumpy things might get for the S&P 500 over the next 30 days. And that word expectation is so important. The VIX isn't looking in the rearview mirror at what already happened. It's trying to see what the road ahead might look like. So how on earth does it read the market's mood? I mean, it's not a mind reader, right? Well, the secret isn't in what investors are saying, but in what they're actually doing with their money. Yeah, the VIX doesn't just send out a survey asking, hey, how are you feeling today? It's much, much smarter than that. It essentially listens to the market's whispers by watching people's actions. It's all about gauging that sentiment by seeing how the crowd is behaving. Are they feeling relaxed or are they starting to get nervous? Okay, here's the really clever part. The VIX basically works by tracking something that acts a lot like financial insurance. When investors get worried that the market might drop, they buy these things called protective options to help protect their investments. And all the VIX does is measure the demand for this insurance. When tons of people are rushing to buy protection, it means anxiety is rising, and the VIX goes up. It's just a brilliant way to put a number on a feeling like fear. So the VIX spits out a single number. But what does a reading of, say, 15 or 30 or even 80 actually tell us? Let's break down how to actually decode these signals. The most important thing to get is that there's this seesaw relationship between the VIX and the market. When fear gets heavy, the VIX goes up, and markets, they often go down. Generally, a VIX reading above 30 signals some serious fear and uncertainty. On the flip side, when confidence is high, the VIX is low, usually somewhere below 20, and the market tends to be pretty stable or even rising. So just remember, high fear, low stocks, low fear, high stocks. There's this old Wall Street saying that captures this idea perfectly. It's the same kind of thinking behind what investors like Warren Buffett preach: be greedy when others are fearful. An extremely high VIX number suggests that panic might be hitting its absolute peak. And for some investors, that intense level of fear can be a flashing sign that a potential buying opportunity is right around the corner. Okay, so this is obviously a really useful tool for traders, but what about the rest of us? Why should you care about the market's mood swings? Well, it turns out the VIX is way more than just a number for Wall Street. It's a window into the bigger economic picture for all of us. Here's the simplest way to think about it. The VIX is kind of like an economic thermometer. When you hear on the news that the fear index is spiking, you'll instantly know there's a lot of uncertainty in the air. Just think back to the market shock in early 2020. The VIX shot up to its highest levels since the 2008 financial crisis. It captured that global feeling of panic perfectly, in a single number. It's a powerful shortcut to understanding the mood behind the headlines. So now, when you see a major global event unfold or hear about a surprising economic report, you've got a brand new lens to see it through. You can ask yourself, how is this going to affect the market's mood? Is it going to calm fears down or kick up some panic? The VIX is always listening. Which really leaves us with one final question to think about. What do you think will be the next big thing to cause a major swing in the market's mood?